Hello, and welcome to our financial statement analysis between Nike and Under Armour. Between Nike and Under Armour, we're going to look at how the business is organized, what business units and what they are. We're going to break down the sales, profits, and cash flows generated by those units. We're going to discuss the ratios in the firm, and we're going to take a look at the DuPont equation and find what is driving the ROE. We're also going to take a look at how the pandemic affected the firm's operations and discuss the future outlook. To get started, here's a quick introduction on both Nike and Under Armour before we start breaking down their revenue segments. Looking at the top line, we have two business segments. We have wholesaling and direct to customer. Wholesaling is to large distributors such as Dick's Sporting Goods, retailers, and direct to customer is through physical sales from owned and operated stores or online sales. Currently, 35% of revenue from Nike is generated through direct to customer and 41% for Under Armour. This is the 3-year average. Wholesaling has dominated the revenue generated by both of these firms over the last 10 years, but we're seeing a shift that is pushing more to direct to customer, which we will discuss the reasons for later on. As we see on the graph on the left, we have total revenue in green, we have wholesaling in dark blue, and we have direct to customer in yellow. As we can see for direct to customer and wholesale percentages, it's quite similar for both firms. An important note to make is that both companies and other competitors in the industry are cutting a lot of their ties with wholesalers in an effort to push more of their revenue from direct to customer. And we will discuss why some of these reasons will be because of the current supply chain issues. If we move to the right, we can see the segment analysis between the products sold. We have footwear, we have apparel, and accessories and equipment. This is where we can start to see some variation between the two firms. So Nike is in the industry mainly for their footwear. That's nearly 70% of their revenue. Whereas for Under Armour, it is apparel. In the graph on the right, we have accessories and equipment in green, we have apparel in dark blue, and we have footwear in the yellow. And as you can see between Nike and Under Armour, there's a large difference between the footwear and apparel. Another segment that we examined was the regional or global distribution of revenues. So this is an important note to make because Nike operates more globally than Under Armour. As we can see in the graph to your left, we have North America sales in yellow, and we have Europe in dark blue, and then we have Asia, Pacific, and Latin America in green. And to discuss the percentages, 41% of Nike's revenue comes from North America, 27% Europe, Middle East, and Africa, and 32% from Asia, Pacific, and Latin America. Whereas almost 70% of Under Armour's revenue comes from North America, 14% from Europe, Middle East, and Africa, and 18% from the Asia, Pacific, and Latin America. Here's a full breakdown of our segment analysis between the revenue segments, product segments, and regional. Now, we've discussed both revenue and product, and one important distinction I'd like to make between Nike and Under Armour is Nike's ability to maintain reasonable operating margins globally, that is between the three different distinct regions, whereas Under Armour is only reasonably efficient at operating in North America. As we examine the operating margins as a whole, Nike is a lot more efficient at producing income at the operating level. But if we break it down into their regional segment, we can see in North America they're reasonably similar, where we have an average of 25% for Nike and 21% for Under Armour. But if we look globally, Nike outperforms Under Armour significantly, especially in the Asia Pacific and Latin America. This global diversity in their operations is a major reason why when you look at the income statement that Nike outperforms Under Armour significantly. This is also important because of how the industry produces its products mainly from Asia or Latin America. So being able to diversify and produce revenue at a greater percentage globally, you're able to mitigate some of the risk, especially such as the pandemic and some of the issues we're having right now. Unfortunately, unlike the regional segment where you broke down the cash flow and operating margin, there wasn't that available information for the direct to customer and wholesaling or the product sales. So instead, I'm going to discuss some parts of that and what I would have looked for if that information was available. One of the most important parts that I would have wanted to look at is the difference between the margins in wholesaling and direct to customer. Now, a large reason I think that there's a push to direct to customer is because of the operating margin difference between the two. In wholesaling, they compared to what you would pay, say, online for a shoe, there can be between 30 and 50% discount that Nike or Under Armour receive compared to direct to customer. This is a large amount of difference where they want to capture that revenue. Now, the difference isn't what they're just going to pocket. There is a cost that comes to direct to customer. You've got maintaining your systems and operations and technology to deliver that experience. And as the technology improves, that's only going to probably become more expensive. I think a big part of the future is going to be into this virtual reality and offering that experience that you would get in person online. So this is something that will come at a cost, but I still think that 30 to 50% additional value is much more valuable than the wholesaling, and that is why we're seeing big cuts to wholesalers. As you can see in the top left, the wholesaler markup, that big piece of the pie there is the retail markup that you would pay at, say, Dick's Sporting Goods. So that right there is the chunk that Nike or Under Armour is going to want to take to itself for direct to customer. Another breakdown that would have been extremely insightful to look at is the operating margins between footwear and apparel sales, because these two firms operate more significantly in the two parts. A reason for why I would like to see this is I believe Nike is more profitable because of their larger revenue generated from footwear sales. It's a lot easier to create apparel and produce a brand in clothing compared to footwear. Footwear is very specific. It's got a lot of parts to it, and it's harder to produce a good product, whereas clothing, it's reasonably simple. So for that additional risk, there should be greater profit margins. Another important part of this is how Nike kind of created its brand. It put its product on the big athletes, the big names, the most important people, so that when young people or people in the sport are watching these players, they want to wear what they're wearing, and they charge a premium for that. That's why you have the Air Jordans, for example, or in my sport, running, everybody wants the top Nike shoe, and they'll pay a massive premium for it. As you can see on the right, we have Eliud Kipchoge. He's the current world record holder for the marathon, the first and only person to run a marathon in under 2 hours. If you go to any fun run, if you go to any marathon, the elite and even middle group of runners will be wearing the shoe on the left there, the Nike Alpha Fly. because that was the shoe he wore during that marathon, and everybody perceives that as it's the shoe, and they'll pay a premium for that. And the difference here is that shoe is $275 compared to a very similar product offered by Saucony that is $200. So you see that 75 different is profit that Nike is making on a very similar product, but the demand and the volume for that premium is still there. You will see more people wearing the Nike shoes than the Saucony. And this is important to describe because Nike, Under Armour, competitors such as Adidas spend so much money on sports every year. Nike and Adidas combined have spent over $3 billion in the sports industry. And the reason is for this. If you, for example, the NFL, it's one of the biggest contracts like Nike would want to sign, because you have so many teams backing behind the sport. You have apparel and all of that gear behind the sport that's generating massive sales. And some of these products are selling at huge premiums, and people are buying them every year. The newest and most current jerseys and etc. So this is a huge part of the profits that they generate is through these since there wasn't any data between the direct customer and wholesaling operating margins, we didn't just leave it at that. We decided we would perform some regressional analysis on the operating margin and the proportion of revenue associated with direct to customer. Now, we do understand that there are many factors that could influence the EBIT margin. Therefore, the results cannot be conclusive. However, there was no statistically significant result from the ANOVA test. The R-squared was 0.01 and the p-value was 0.8. And we had a critical value of 5%. So it significantly fails the test. So as of now, the direct customer percent of revenue does not appear to have an impact on the EBIT margin. To note, this was compared over a period from 2013 to 2021 only for Nike, since Under Armour's earnings were quite volatile over that. If we look at the firms as a whole, between Nike and Under Armour, we can see that the operating margins and profits for Nike is significantly better. At the top line, gross profit margin is reasonably similar between the two, but as we move down into post-operating expenses, Nike significantly outperforms Under Armour, as we can see to the average profit margin of nearly 10% for Nike, and it's actually negative for Under Armour. It's also a lot less volatile for Nike compared to Under Armour, whereas they seem to have good years, bad years, and it's kind of all over. The capital structure of both firms does not appear to be significantly different. We have Nike slightly more levered than Under Armour, especially in the latter years. Looking to the financial health, Nike is able to generate a lot more EBIT to their interest expense with a multiple of 34.5. So it's more than able to cover its interest expense, whereas Under Armour only 6.6, which may describe why Nike is able to be more levered than Under Armour. If we look at the compounded annual growth rate of revenue, it's 7% for Nike compared to 3% for Under Armour. For the EBIT, it was easier to analyze Nike because they had increasing EBIT, whereas Under Armour did not. Other important notes to make on their ratios: the asset turnover is reasonably similar for both. The current and quick ratios are not significantly different, but Nike's slightly better positioned in terms of liquidity. The days receivable stronger for Nike, payable stronger for Under Armour, and days in inventory better for Nike. The cash cycle is very similar. Nike additionally turns over their fixed assets quicker than Under Armour. Now, discussing how the firm's changing over the past 5 years, if you take the pandemic out of the equation, Nike has positioned itself very well with increasing operating margins and a steady revenue growth. Under Armour has shown some good signs of growth from 2017 to 2019. It also recovered well from the pandemic to post strong margins for 2021. Both Nike and Under Armour have increased their leverage over the 5-year period, with Nike more aggressive in their leverage structure, where it started 2017 with an equity multiple of 1.9 and increased that to 3.9 in 2020. If we look on the balance sheet, there is a significant reduction in equity for Nike between that period. Therefore, the asset to equity ratio is not just a result of increased debt. However, equity did pick up again in 2021 to the same levels as 2017 due to a significant spike in retained earnings for Nike. Debt was 3.4 billion as of 2017 for Nike, and then it increased up to 9.4 in 2021. That the greatest increase came in 2020 when interest rates were very low. Under Armour, on the other hand, has kept the book value of equity relatively stable over the 5-year period. Debt did increase in 2020, but is at an all-time low as of 2021. Identifying back to before, because of their operating margins, this is probably a reason that they haven't been able to increase their debt as much. So that could be an opportunity if Under Armour is able to maintain its EBIT margin of being able to grow their capital structure in favor. So what is driving ROE through the DuPont equation here? So we can see that the return on equity is very different for the two firms. Nike is trending upwards, whereas Under Armour seems to be kind of swinging from up and down. It's quite volatile. And so if we look at the three parts to the equation, let's start with the equity multiple. It's slightly better positioned for Nike, but it's not significant enough to explain the difference. Asset turnover, still not significantly different. Nike does turn the assets over slightly quicker than Under Armour, but this is still not enough to explain the significant difference. Now let's go to profit margin. Well, this explains the trend right here. We have an average of 9.8 for Nike over the 5 years, and we have negative 1.2 for Under Armour. So right there we can see that is the difference. Also, the volatility of Under Armour's return on equity is explained by their profit margin. As we can see that the trend is very up and down. We go from negative 1 to negative 0.9 to 1.7% to negative 12.3% profit margin. So that explains, it correlates exactly to the trend in the graph as seen below for the return on equity. To explain why is the profit margin so much better for Nike, well, if we take a look at their income statement to operating income, we can see the percentage of operating expenses to revenue is much lower for Nike. So they're generating more profit per dollar of revenue, and that is why that they're able to outperform Under Armour in their return on equity and their other ratios. Additionally, not seen in this income statement here is below operating income. Under Armour has a lot more charges and expenses and random occurrences that impact the net income. And so that's another reason why the net profit margin for Nike is much stronger than Under Armour. To explain how did the pandemic impact these firms? Well, if we go back to the start, remember that a big proportion of their revenue still comes from wholesaling. Well, the whole world almost shut down. Retailers stopped selling, and so when they can't sell product, they're not buying inventory. So both of these firms suffered dramatically from the shutdowns imposed by the government. The operating expenses continued for both firms while the revenue dropped, so operating margins decreased. As revenues only came from online sales, we saw a large reduction in the profit margins for both Nike and Under Armour. However, it seemed to impact Under Armour a lot more significantly than it did Nike. I believe the reason for this is because of Nike's more global presence, and so they were able to still generate more revenue online sales in other countries compared to Under Armour, where most of their revenue came just from North America. I also think that it would be easier to not buy apparel rather than footwear, because kind of always need footwear, but sometimes apparel you can make last a little longer. So Nike is a little bit in a better position for their revenues generated in that sense. However, post the worst part of the pandemic, when the openings occurred again, the firms seemed to pick up even better than the pre-pandemic levels. So the outlook for the future looks good for both firms post. So let's talk about the future outlook for both of these companies and the industry. So the main points that I see important in this industry is innovation, the direct-to-customer experience, refining and specialty, the supply chain issues, inflation, and other economic issues. So starting with direct to customer, that's only going to continue to grow in demand, especially post-pandemic. This has just accelerated the need for this. Online sales in almost every industry has experienced an explosion of growth since the onset of the pandemic. And as technology continues to increase, especially in virtual reality, the need for wholesalers will decline. Now, when I talk about wholesalers, I still see your kind of outlet malls and your big distributors staying in place, but I think it'll be more the smaller niche stores which will be significantly hurt by this change in the demand. The companies that are able to maintain and grow and have great earnings are going to be the ones that are going to implement this direct customer experience at best. And I think Nike especially will be a dominant player in this industry. Under Armour hopefully can play a similar role, but you're going to definitely see this growth in direct to customer continue into the future. Going over the supply chain issues in more depth, it currently takes Nike 80 days to get goods from Asia to North America. That's double the pre-pandemic transit time. These halts in manufacturing facilities in Vietnam, where over 40% of the Nike's footwear and apparel units are made, is continuing to reduce supply. As Nike analysts predict, the demand will continue to outpace supply into the future. And if we tie it back to direct to customer, that's further going to push these companies that are experiencing these issues to sell their products where the operating margins are. So whereas wholesaling has lower margins, they're not going to supply as much inventory to those accounts to the same extent as pre-pandemic levels. Going into more depth in terms of specialization, I think as there's more players in the industry and there is possibly less growth opportunities to be made, more of these companies are going to have to get rid of underperforming products and move into specialization. However, that being said, your producers such as Nike and a competitor at Adidas are most likely going to still perform in a lot of product segments and industries in sports just because of their brand name. Under Armour, on the other hand, has not been around as long and doesn't have quite the same name, and it's more prevalent in North America, maybe limited to being more specialized in their products. Adding to the supply chain issues, we have inflation running high, increasing the cost of producing these goods. Neither Nike or Adidas is in the market for producing low quality products at low prices. Therefore, they're going to have to implement strategies for cost savings, which is, again, direct to customer is going to be beneficial in strong performance. Another area to note of possible concern in the future is the increased interest rates, with Nike's capital structure increasing significantly over the low interest rate period. If there's a need to refinance in the future, this could become an issue if interest rates continue to rise. This also could be an issue for Under Armour, as they may need to increase their debt in the future to continue growth, as their operating margins increase. The availability to take out debt may be there, but the interest rates may be significantly higher than what would be ideal for their capital structure. And to conclude this analysis, based on historical data, Nike has outperformed Under Armour in almost every aspect, maintains higher profit margins, a greater return on equity and invested capital, greater revenue growth, and is in a more financially stable position. Nike has been the dominant player in the industry for most of the 21st century. Their product is endorsed by many celebrities and high-performing athletes. The value in its name alone is immense. Under Armour also is very prevalent in elite sports, but not diverse across the sports industry as Nike is. It is more recognized as a large player in North America compared to Nike, that is globally a top performer. Thank you for listening. I hope you enjoyed this analysis between Nike and Under Armour.